Hello, this is Gaur and today's topic is cost of capital and financing decision. Let's begin with the introduction. There are three main finance decisions, namely financing decision, investing decision and distribution decision. Let us see what is financing decision. Financing decision refers to acquisition of required funds. A corporate entity can raise funds through issue of equity shares, preference shares, debenture or bonds, borrowing of loan and by utilizing retained earnings. Every source of funds has its own cost, which includes issue expenses, dividend on preference shares and interest on debt and even opportunity cost of retained earnings. Now let us clarify what is investing decision. Investing decision refers to employment of finance raised in the business for longer period of time. The decision of purchase of non-current assets like plant and machinery, land and building, tools and equipments, furniture, vehicles, long-term investments, etc. is investing decision. The third decision of distribution decision refers to how much profit to be distributed by way of dividend and how much profit should be retained in the business for future growth of the business. Now let us understand the concept of cost of capital. Cost of capital is the rate of return that a firm must earn on its investments to maintain its market value. Cost of capital is the required rate of return on its investments which belongs to equity, debt and retained earnings. If a firm fails to earn return at the expected rate, the market value of the shares will fall and it will result in the reduction of overall wealth of the shareholders. According to John J. Hampton, cost of capital is the rate of return of the firm required from investment in order to increase the value of the firm in the marketplace. According to Solomon Ezra, cost of capital is the minimum required rate of earnings or the cut-off rate of capital expenditure. And according to James C. Van Horne, cost of capital is a cut-off rate for the allocation of capital to investment of projects, and it is the rate of return on a project that will leave unchanged the market price of the stock. A firm's return on investment must be at least equals to the cost of capital. Hence, cost of capital is defined as the cut-off rate or the target rate, or we can say hurdle rate or required rate of return. The finance manager must take careful decision of raising funds keeping in view its cost of capital, because cost of capital affects earning capacity and value of the firm. Cost of capital is based on certain assumptions which are closely associated computation of the cost of capital. These assumptions are: first is, it is not a cost as such, it is merely a hurdle rate. Second, it is the minimum rate of return. Third is, it consists of three important risks such as zero risk, business risk and financial risk. After understanding the concept of cost of capital and financing decision, let us see the relationship between these two. As we discussed, financing decision is a decision of using a particular source of capital to raise fund. It is obvious that a wise financial manager will compare cost of capital of each alternative source of fund, and the most cheapest source will be preferred to raise the funds. The lower the cost of capital, more margin for profit available for shareholders, which consequently maximizes the wealth of shareholders and value of the firm. Now let us understand how the cost of capital is calculated. Computation of cost of capital consists of two important parts. First is measurement of specific cost and second is measurement of overall cost of capital. Let us see measurement of specific cost. It refers to the cost of each specific source of finance like cost of equity, cost of preference share, cost of debt and cost of retained earnings. Let us discuss each one by one. Cost of equity. Cost of equity capital is the rate at which investors discount the expected dividends of the firm to determine its share value. Conceptually, the cost of equity capital, which we denote by KE, is defined as the minimum rate of return that a firm must earn on the equity financed portion of an investment project in order to leave the market price of the shares unchanged. Cost of equity can be calculated from the viewpoints of various approaches such as dividend price approach, dividend price plus growth price approach, earning price approach. Let us discuss dividend price approach first. The cost of capital, or we can say cost of equity capital, will be that rate of expected dividend which will maintain the present market price of equity shares. Cost of equity, that is KE, is denoted by D divided by NP, where KE is cost of equity capital and D is dividend. NP is net proceeds of an equity share. Now let us understand it by an example. A company issues 1 lakh equity shares of rupees 10 each at a premium of 10%. The company has been paying 25% dividend to equity shareholders for the past 5 years and expects to maintain the same in the future also. Let us first calculate dividend per share. As rate of dividend is 25%, dividend per share D is equals to face value per share, that is rupees 10 into 25%, which is equals to rupees 2.5 per share. Net proceeds per share is equals to face value plus premium, which is equals to rupees 10 plus rupees 1, that is 10% of rupees 10 face value, which is finally equals to rupees 11. The cost of equity capital of newly issued shares can be calculated as KE is equals to D divided by NP, which is equals to 2.5 divided by 11 multiplied by 100, which is equals to 22.73%. If the market price of an equity share of an existing company is rupees 20, the cost of equity capital can be calculated as KE is equals to 2.5 divided by 20 multiplied by 100, which is equals to 12.5%. Another is dividend price plus growth, that is D by P plus G approach. The cost of equity is calculated on the basis of expected dividend rate per share plus growth in dividend. It can be measured with the help of a formula. KE is equals to D by NP plus small g, where KE is cost of equity capital, D is dividend per share, small g is expected growth in dividends, NP is net proceeds of an equity share. Now let us understand with the help of an example. A company plans to issue 1 lakh new shares of rupees 10 each at par. The flotation costs are expected to be 5% of the share price. The company pays a dividend of rupees 1 per share initially and growth in dividends is expected to be 10%. For calculating cost of new issue of equity share, let us first calculate dividend per share D and net proceeds NP per share. Dividend per share is equals to face value rupees 10 into 10% rate of dividend, which is equals to rupees 1 dividend per share. Net proceeds per share is equals to rupees 10 face value minus flotation cost rupees 0.5, that is 5% of rupees 10. Hence, net proceeds per share is equals to rupees 9.50. Cost of equity KE is equals to D divided by NP plus G, which is equals to 1 divided by 9.5 multiplied by 100 plus 10% and which is equals to 10.53 plus 10, and the answer is 20.53%. If the current market price of an existing listed company is rupees 20, KE is equals to 1 divided by 20 multiplied by 100 plus 10%, which is equals to 5 plus 10 and which is further equals to 15%. Now we will discuss earning price approach. Under this approach, cost of equity is based on the future earnings prospects of the equity. The formula for calculating the cost of equity according to this approach is KE is equals to capital E divided by NP, where capital KE is equals to cost of equity capital. NP is net proceeds of an equity share. Let us understand calculation of cost of equity under earning price approach with the help of an example. A company issued 1 lakh equity shares of rupees 10 each at a premium of rupees 2 per share. Total earnings for the year was rupees 5 lakh. Flotation cost per share is rupees 1. For calculating the cost of equity under this approach, let us first calculate earnings per share and net proceeds per share. Earnings per share capital E is equals to total earnings divided by total number of equity shares, which is equals to 5 lakhs divided by 1 lakh, which is further equals to rupees 5 per share. Net proceeds per share, that is NP, is equals to rupees 10 face value per share plus rupees 2 premium minus rupees 1 flotation cost, which is equals to rupees 11 per share. Now, cost of equity KE is equals to 5 divided by 11 multiplied by 100, which is equals to 45.45%. Apart from equity shares, the other sources of funds in debt. Debt refers to borrowed funds or a fixed period. During the fixed period, interest is payable at specific rate, and at the end of the period, the debt is redeemed or repaid. Now, let us understand what is cost of debt and how it is calculated. Cost of debt is the after-tax cost of long-term borrowed funds that may be issued at par, at premium or at discount. Debt issued at par means debt is issued at a face value of the debt without any premium or discount. It may be calculated with the help of the following formula: KD is equals to 1 minus T whole multiplied by R, where KD is cost of debt capital, T is tax rate, R is debenture interest rate. If the debt is issued at premium or discount, the cost of debt is calculated with the help of the formula KD is equals to I divided by NP multiplied by 1 minus T, where KD is equals to cost of debt capital, capital I is equals to annual interest payable, NP is net proceeds of debenture, T is tax rate. Let us understand with the help of an example. First example is, if A Limited issues rupees 10 lakh at 8% debentures at par, the tax rate applicable to the company is 50%. B is, if B Limited issues rupees 1 lakh 8% debentures at a premium of 10%, the tax rate applicable to the company is 60%. C is, if C Limited issues rupees 1 lakh 8% debentures at a discount of 5%, the tax rate is 60%. D is, if D Limited issues rupees 10 lakh 9% debentures at a premium of 10%, the cost of flotation are 2%. The tax rate applicable is 50%. In all cases, we have to compute the after-tax cost of debt, as the firm saves on account of tax by using debt as a source of finance. Cost of debentures for A Limited will be, cost of debentures KD can be written as I upon NP multiplied by 1 minus T, which is equals to 8,000 whole divided by 1 lakh whole multiplied by 1 minus 0.5, which is further equals to 8,000 divided by 1 lakh whole multiplied by 0.5, and the answer is 4%. So, cost of debentures for B Limited will be KD is equals to I divided by NP multiplied by 1 minus T, where NP is face value plus premium, which is equals to 1 lakh plus 10,000. So, it is 1 lakh 10,000. So, KD is equals to 8,000 divided by 1 lakh 10,000 whole multiplied by 1 minus 0.6, which is further equals to 8,000 divided by 1 lakh 10,000 multiplied by 0.4, and the answer is 2.91%. C is KD is equals to I divided by NP multiplied by 1 minus T. Net proceeds in P will be face value rupees 1 lakh, discount rupees 5,000. So, it is equals to 8,000 divided by 95,000 whole multiplied by 1 minus 0.6, and the answer is 3.37%. Cost of debentures for D Limited will be KDA is equals to I divided by NP whole multiplied by 1 minus T, where NP is equals to 10 lakh plus 1 lakh minus flotation cost, which is equals to 11 lakh minus 2% of 11 lakh, which is further equals to 11 lakh minus 22,000, which is equals to 10 lakh 78,000, which is further equals to, and finally KDA is equals to 90,000 divided by 10 lakh 78,000 whole multiplied by 1 minus 0.5, and the answer is 4.17%. Now, let us move on to next topic, that is cost of perpetual debt and redeemable debt. The cost of perpetual debt is the rate of interest specified at the time of incurring debt or issuing the debentures, while cost of redeemable debt is calculated by the formula of KDB is equals to I plus 1 upon N whole multiplied by P minus NP into N, which is further divided by 1 divided by 2 into P plus NP, where I is annual interest payable, P is par value of debt, NP is net proceeds of the debenture, small n is number of years to maturity, KDB is cost of debt before tax. For calculating cost of debt after tax, the following formula is used. KDA is equals to KDB multiplied by 1 minus T, where KDA is cost of debt after tax and KDB is cost of debt before tax and T is tax rate. Let us take an example. A company issues rupees 10 lakh at 10% redeemable debentures at a discount of 5%. The cost of flotation amount to rupees 25,000. The debentures are redeemable after 8 years. Calculate before tax and after tax cost of debt assuring a tax rate of 55%. KDB is equals to I plus 1 divided by n multiplied by P minus NP into n whole divided by 1 by 2 into P plus NP, which is equals to 1 lakh plus 1 divided by 8 multiplied by 10 lakh minus 9 lakh 25,000 whole divided by 1 by 2 multiplied by 10 lakh plus 9 lakh 25,000, which is equals to 1 lakh plus 9,375 whole divided by 9 lakh 62,500, and the answer is 11.36%. After tax cost of debt KDB is equals to KDA multiplied by 1 minus T. So, it is equals to 11.36 multiplied by 1 minus 0.55, which is equals to 5.11%. Next topic is cost of preference share capital. Cost of preference share capital refers to the amount which is payable to the preference shareholder in the form of dividend at a fixed rate. There are two types of preference shares, irredeemable and redeemable. Cost of irredeemable preference share is calculated by formula of KP, which is equals to DP divided by NP, where KP is cost of preference share, DP is fixed preference dividend, NP is net proceeds of the preference share. Cost of redeemable preference share is calculated in the following manner. KP is equals to DP plus P minus NP divided by N whole divided by P plus NP divided by 2, where KP is cost of preference share, DP is fixed preference share, P is par value of debt, NP net proceeds of the preference share, small n is number of maturity period. Let us take an example. A company issues 20,000 at 8% preference shares of rupees 100 each. Cost of issue is rupees 2 per share. Calculate cost of preference share capital if these shares are issued first at par, second at a premium of 10% and third at a discount of 6%. Let us see the solution. Cost of preference share capital KP is equals to DP divided by NP. First is at par. At par, it is equals to 1,60,000 divided by 20 lakh minus 40,000 whole multiplied by 100, which is equals to 8.16%. Another is at a premium of 10%, it is equals to 1,60,000 divided by 20 lakh plus 2 lakh minus 40,000 whole multiplied by 100, which is equals to 7.40%. Third is at a discount of 6%, it is equals to 1,60,000 divided by 20 lakh minus 1,20,000 minus 40,000 whole multiplied by 100, which is equals to 8.69%. Move on to next topic. Let's take an example of computing cost of redeemable preference share. A Limited issues 10,000 8% preference shares of rupees 100 each, redeemable after 8 years at a premium of 10%. The cost of issue is rupees 2 per share. Calculate the cost of preference share capital. Let us see the solution. KP is equals to DP plus P minus NP whole divided by N whole divided by P plus NP divided by 2, where DP is equals to 10,000 multiplied by 100 into 8%, which is equals to 80,000. P is equals to 10 lakh plus 1 lakh, which is 11 lakh. NP is equals to 10 lakh minus 20,000, which is equals to 9 lakh 80,000. Small n is equals to 8 years. The solution is it is equals to 80,000 plus 11 lakh minus 9 lakh 80,000 divided by 8 whole divided by 11 lakh plus 9 lakh 80,000 divided by 2, which is equals to 95,000 divided by 10 lakh 40,000. Now let us see the cost of retained earnings. When company invests profit retained in the business, it utilizes that part of profit which is not distributed among the shareholders. Hence, it does not involve any explicit cost in terms of dividend or interest payment as involved in other sources of income. But it does have a cost which is measured as the return the shareholder had foregone by not investing his share of earnings elsewhere. Here KR is equals to KE multiplied by 1 minus T and 1 minus B, where KR is equals to cost of retained earnings, KE is cost of equity, small t is tax rate, B is brokerage cost. Let us see an example. A firm's KE, which is return available to shareholders, is 10%. The average tax rate of shareholders is 30%, and it is expected that 2% is brokerage cost that shareholders will have to pay while investing their dividends in alternative securities. Now, what is the cost of retained earnings? The solution is cost of retained earnings KR is equals to KE multiplied by 1 minus T and 1 minus B, which is where KE is rate of return available to shareholders, T is tax rate, B is brokerage cost. So, KR is equals to 10% multiplied by 1 minus 0.5 multiplied by 1 minus 0.02, which is equals to 10% multiplied by 0.5, which is further multiplied by 0.98, it is equals to 4.9%. The next topic of our discussion is weighted average cost of capital. Weighted average cost of capital, which is also referred as combined or composite cost of capital, and it is called weighted average of the specific cost of different sources of capital, where each source of capital is assigned a weight according to its relative share in capital structure of the company. The computation of the overall cost of capital KO involves certain steps. First is assigning weights to specific cost. Second, multiplying the cost of each of the sources by the appropriate weights. Then dividing the total weighted cost by the total weights. The overall cost of capital can be calculated with the help of the following formula. KO is equals to KD multiplied by WD plus KPWP plus KEWE plus KRWR, where K naught is equals to overall cost of capital, KD is cost of debt, KP is cost of preference share, KE is cost of equity. KR cost of retained earnings, WD is percentage of debt of total capital, WP is percentage of preference share to total capital, WE is percentage of equity to total capital, and WR is percentage of retained earnings. Weighted average cost of capital is calculated with the help of formula. The formula is KW is equals to summation of XW divided by summation of W, where KW is weighted average cost of capital, X is cost of specific source of finance, W is weight or the portion of specific source of finance. Let us take an example. The following is the capital structure of the company: debenture of rupees 100 each at 10 lakh, redeemable preference share of rupees 100 each 4 lakh, equity shares of rupees 10 each 15 lakh. The market price of the sources is, first is market price of debenture is rupees 105, second market price of preference share is rupees 120, and third is market price of equity shares is rupees 20. As shown in this table, the specific cost percentage for debenture is 5%, for preference share it is 10%, and for equity it is 15%. Let's see the solution. For debenture, amount is 10 lakh, preference share 4 lakh, then equity it is 15 lakh. Summation of all these weights is 29 lakh. Cost taken are 5% for debentures, 10% for preference share, and 15% for equity shares. So, if we calculate weighted cost, we calculate debenture weighted cost as 50,000, for preference share it is 40,000, and for equity it is 2,25,000, and summation of XW is equals to 3,15,000. Weighted average cost of capital KW is equals to summation XW divided by summation W. So, it is equals to 3,15,000 divided by 29 lakhs, whole multiplied by 100, and the answer is 10.86%. Last topic of today's session is marginal cost of capital. Marginal cost is the weighted average cost of new finance raised by the company, and it is the additional cost of capital when the company goes for further raising of finance. Let's summarize at the end. Today we have discussed what are financial decision, what is cost of capital, what is relationship between financing decision and cost of capital, and how the cost of capital is calculated for various sources of funds. Thank you.